Well, hello everyone. We enter into the second part of this seminar. So we finish international trade, and now we get into international finance. International finance is extremely interesting because it helps you to understand all the crisis in all the big debt crisis that we had during the last couple of decades in Southeast Asia, Latin America, Russia, and especially all the financial crisis of the last years, starting in 2008, especially in Europe. I mean, all of them are very much explained, but what we are going to see during these weeks. Today, the definition is mostly an introduction of a set of definitions that I will give you some of them. Remember that my goal is not to explain all the book. You can benefit much more by reading the book. I'm just trying to summarize the main ideas, especially when they are connected with mathematical issues that require some more speaking, if you want. So we are going to cover three chapters. The first chapter is about the balance of payments. Balance of payments provides a summary statement of the international transactions for a nation for a specified period of time. I mean, okay, you have basically two things. You have credit transactions. Credit transactions involve an inflow of money, of foreign exchange into your country, uh, led by exports mainly, but by other accounts. The book uses the term financial inflows. It's kind of confusing because the reality is that you will see that these are accounts, that specific accounts like foreign assets, assets abroad. The term financial inflow can be a little bit misleading. Hope you don't get confused. The second is debit transactions. Debit transactions means outflows of foreign currency. So especially imports, and also in the case of some specific accounts, when they involve an outflow of foreign exchange from your country, from the home country. So they all go into double entry bookkeeping. So you always have a debit and a credit. And normally the credit is what means an inflow and of funds. And here, in this case, the debit is only to set the balancing account, if you want. In this case, the balancing account is a little bit confusing because the book uses this term financial outflow, and you really don't understand. I mean, why? If export means inflow, why are we talking about outflow? Doesn't make any sense. The reality is that what you're having here is the account in which the money is deposited. Like, for example, if you are exporting from the US to Europe, and the exporter has an account in a bank in Europe, what you should write here is the name of the account overseas in Europe, and this means that this money is accredited in that account. So you see that the terminology that the book uses can be a little bit misleading. The same happens here. Is imagine that you go to London, and in London you spend some money. This is like a service import, if you want. And same thing here. This money is deposited in an account somewhere to compensate the import, quote unquote import, that you are performing. This is something that you are familiar with. So the net exports in the US have been very, very negative during the last couple of decades. And always you need to have a compensation. If you have export, I mean, you have an outflow of money, then you need to have an inflow of money, and this comes from the capital account, and this can be just debt. So this it doesn't mean that this is good news. Probably it's not good news. This is because the country is getting more and more foreign debt. And you see that when you get into the investment position of the country. Investment position involves this kind of stock account, like debt, for example. So you can see that this is the reality. I mean, the U.S. have been increasing the amount of debt, becoming the largest debtor country ever. Okay, let's get into the second chapter, and this is once again we are going to see some definitions, and probably you will find that these definitions are irrelevant, and probably they are. But what matters is you get familiar with the terminology, because the key issue here is that there is two types of exchange, that is a foreign exchange, that is fixed foreign exchange and float or foreign exchange systems, if you want. We're not going to talk about that. We'll talk about next class. But practically, most of the financial crises were global financial crisis have been dealt by a fixed exchange rate system like the euro today, or the systems that Southeast Asia or Latin American countries had. So this is kind of the why this discussion is interesting. First, you have to realize that there are different participants in the foreign exchange market. So you have the people, exporters, importers, consumers, whatever. Then you have the banks, then you have the brokers, then you have the central banks. These are all the participants. And this gives you, and this is kind of interest to spend a little time in this graph, because it seems relatively simple, but basically what you are describing here is this is the foreign exchange, the price of the foreign exchange, in this case the price of the euro, and this is the quantity. You know, always when you talk about demand and supply, here you put the price, that is the dollars per euro, and here you put the quantity, the amounts of dollar per euro that you are buying. And of course this is the equilibrium. And what is interesting is that you realize that what is a depreciation, and this is kind of confusing sometimes, because you see that the depreciation of the dollar means that you have to pay more dollars per euro. Sometimes I think it's useful to have like a visual image, that is that imagine that you have one group of guys pulling like a rope, and the other side you have other group of guys. If in one side at the left, let's say you have one guy, and at the right you have three guys, which guys individually are stronger? It's obvious that the guy at the left, because by himself he's able to put in equilibrium the three guys at the right. So the three guys at the right are exactly 1/3 less strong, if you want, than the guy, or weaker than the guy at the left. Well, the same happens here. If you need to buy more dollars, if you need to have more dollars to buy 1 euro, you are saying that the dollar is getting weaker. So this is a depreciation. So this is kind of the concept here. Okay, so in this case, if the supply curve is moving to the left, it means that the price of the euro is going to raise, or the price of the dollar is going to fall. And we are talking about euros here, so the price of the euro is going up. Then people will buy less euro. It means that the supply of euros will fall, if you want, for whatever reason. Okay, so what happens if, for whatever reason, the government sets artificially a price different from the price in equilibrium? What happens is automatically you will have, let's say in this case, that the dollar is getting weaker, is getting cheaper. Okay, if the dollar gets cheaper, automatically you will have more exports of US products and less imports, if you want. And this will this will strengthen the dollar, and the dollar will move down to the equilibrium price, you see. So there is a set of external factors that impact on the supply and demand of dollars, or supply and demand of euros, and this will bring the price to the equilibrium. And in the next chapter I will explain in more detail what are all those factors. Okay, so how do they determine this price of equilibrium, this exchange rate of equilibrium, if you want? And there is a set of theories, if you want. The first is there is a set of factors that impact on the price of the dollar, if you want, and the same happens with the price of the euro. So you have to look at both sides. The first is the relative rates. You see that the word relative rates of economic growth. Let's say that the US is growing faster than Europe, consequently will have relatively more demand for imports because of its internal growth, and this will move the value of the dollar accordingly. The second is the rate of inflation. Let's say that the US rate of inflation is higher than the European rate of inflation. So consequently, this will kind of weaken the interest rates in the US, and this will reduce the demand for dollars because the real interest rates will fall. And consequently, this will change the relative price between the dollar and the euro, the exchange rate. The third is the changes in interest rates. As I've just said, if the interest rate in the real interest rate in dollars is larger than the real interest rate in euro, so there will be a demand for dollars. So, and this will generate an inflow of dollars into the U.S. and this will automatically produce a change in the interest rate in the exchange rate in the U.S. Finally, expectations of everything, expectations of inflation, expectations of growth, expectations of interest rates. All of these will impact on either of the two currencies and automatically will produce a change in the foreign exchange rate. So, and there are, in addition, a set of theories that are implicit in the explanations that I've just given you. Number one is called the trade approach. So having different levels of exports and imports will produce levels of demand or supply of a specific currency, and this will appreciate or depreciate that currency. Second, what is called the purchasing power theory, that basically means that if you don't have any trade barrier, like let's say the cost of transportation, the cost of insurance, the cost of financing the trade, etc., etc., if the market were absolutely perfect with absolute no cost of export or imports, this is ideal. This never exists, but assuming that this may happen, okay, in that case, all the products all over the world should have the same value, if you want, the same price, that is expressed in different currencies. So buying a glassware sells for $1 per unit. Okay, automatically the yens and the euros and everything will adjust to reflect that the price of the glassware is the same all over the world. The same theory is monetary, a model of exchange. Somehow in the models that I show you, it's assumed that there is a specific demand for one specific currency. And this is based on many factors. So why there is some demand? Well, because of the expectations of growth, because of the expectations of inflation, the expectations, whatever. All of those impacts in the monetary model of exchange rate. Finally, there is an asset portfolio. So money is an asset, and people may be willing to buy some asset because it's safer, because it provides some benefits, whatever. So there is a set of theories. But at the end of the day, all those theories impact on this model that I showed you before. Here, what you have is the exchange rate of dollars versus euros. So basically, what is the price of €1 based on expressed on dollar terms? Let's say that initially is $1, €1, and here you have time. So what happens when you, for whatever reason, produce in this case a depreciation of the dollar, but the expectation that we discussed before is a different value? Okay, with time. So let's say that the exchange rate, when you make a change, the government makes a change or whatever, or the central bank or the Federal Reserve. So you have 1.16 here, but the expectation is that the value of the euro should be at 1.10. So you will see that with time, this is what is going to happen. The value of the euro will fall to 1.10. So you see that there is some dynamics, that will impact on this exchange rate. Okay, so how good are all these models to forecast? And the response is, okay, they are not so strong, so they have not been successful at predicting future exchange rate. So for a set of reasons, exchange rates are highly influenced by new information. Expectations, exchange rate markets tend to be self-fulfilling, so this is the rational expectations, if you want, theory applied to this foreign exchange. Okay, this is it. Hope you enjoyed the subject.